Hello guys, this week we're going to talk about valuation. So basically we're going to talk about how to value a merger acquisition. So to get to that question, the many steps we need to take. Especially, if you have taken corporate finance classes before, or if you have taken classes similar to that kind of class before, that the content might be easier for you because to do valuation, we need to go from the very basic net present value method and then develop based on that. So I'm gonna gradually develop framework for valuing the merger acquisition in this topic. Uh, I have broken the I have broken this topic into two parts. We're gonna talk about the methodology and then I'll show you examples for this week, and next week we're gonna finish the second half, and of course also talk about the next topic. So basically, we're gonna cover the DCF model basics. So DCF model is the central model that we're gonna rely on to do valuation, and essentially that's also the model that practitioner, for example, investment bankers rely on when they are trying to value merger acquisition or value a company, basically, right? There are many basics that we will cover. We can also talk about the capital asset pricing model briefly. That's an intermediate step towards estimating some of the inputs. For example, we'll use the capital asset pricing model to estimate the cost of equity, but I'm not gonna go deep into this capital asset pricing model because that belongs to an investment class or that belongs to a corporate finance class, but I won't go into that one for detail, but I'm just gonna briefly talk about intuition and how we're gonna use the model to estimate the cost of equity and ultimately the cost of capital. Also, we're gonna talk about the estimation of beta, right? So beta is the key estimate for us to derive the cost of equity. So that is also important. And then we're gonna talk about the free cash flow valuation principles and I'll show you some examples. So we're gonna start from a case that is about controversial negotiation that is related to deal premium. Basically, this case was was between the merger acquisition between the TransUnion and then Pritzker, right? So in September 1980, this guy called Jerome Van Gordon, who was the chairman and CEO of TransUnion, suggested to this guy called Jay Pritzker that Pritzker is a company name, of course, right? Pritzker made a 50-55 a share merger bid for TransUnion, right? Which would be merged with the Maron Group, a company controlled by the Pritzker. So then this CEO called a board directors meeting on September 20th on 1 day notice. In that case, most of the directors had not been advised of the purpose of the meeting. But on that meeting, they have gone through a 20-minute presentation on the Pritzker bids and the terms of the offer, right? Because they got it offered by Pritzker. And then the offer allowed TransUnion to accept competing bids for 90 days, right? And some directors on the meeting thought that the 55 offer would be considered only the beginning of the range of the value of a company. Yeah. And after 2-hour discussion, directors agreed to the terms of the offer and the merger agreement was executed. Right? And the TransUnion directors were sued by the shareholders subsequently because the shareholders thought that the offer was inadequate. Right? And then, the shareholders sued the directors, then the case went to the Delaware court. The Delaware court found that the decision to sell the company for 55 was not an informed business judgment based on the following three kind of facts. For example, the directors did not adequately inform themselves in forcing the sale of the company and in the per share purchase price, meaning that they're not informed in making this decision to sell the company. Second, directors were uninformed as to the intrinsic value of the company, right? They don't know, they didn't even try to estimate the intrinsic value of the company. Finally, directors were grossly negligent in approving the sale of the company upon 2 hours consideration, right? And they don't have prior notice. They also do not have any existence of a crisis or emergency. They just all of a sudden decide to sell the company. So, but on the director side, they also have defended themselves. So the key defense was that a substantial premium in this offer, the Pritzker's 55 offer, over TransUnion's market price of 38 per share. Yeah? So the merger price offered to the shareholders represented a premium of 62% over the average of the high and low prices at which TransUnion had traded in 1980. Right? So that represents a premium of 48% over the last closing price. That also was a premium of 39% over the highest price in the past 6 years, right? So basically the argument is that, well, you see, the acquirer paid a lot, right? So, I mean, the shareholders should not feel that the offer was inadequate, right? Because, I mean, obviously, the acquirer paid a lot. Second, directors were trying to find excuses, right? The board's collective experience was adequate to determine the reasonableness of the fiscal offer. And third, the attorney advised them that they might be sued if they rejected the Prisco proposal. Right? Finally, there was the shareholders' overwhelming vote approving the merger. Right? So the majority of the shareholders approved the merger, but still some of the shareholders, they feel that the offer was inadequate. And the directors in this case also considered the comments of Donna Romans, right? Who was the TransUnion's chief financial officer, right? This guy stated that a 55 offer was at the beginning of the range within which an adequate value of TransUnion lay, right? And this guy's analysis was prepared to determine whether the target company could service the necessary debt to fund the leverage buyout he was contemplating. Right? That's a leverage buyout deal. So on the other hand, the Delaware Court had not considered his analysis sufficient to approve a merger because it was not a valuation study. It's not a very strict valuation study, right? So what is valuation study? That's a valuation study based on discounted cash flow model, right? That we're gonna talk about massively in this topic. So the takeaways from this case is that it affirms the need for formal valuation analysis in all mergers, acquisitions, and LBOs, right? Even in leverage buyout, you need to do a formal valuation study. And under the business judgment rule that was set out by Delaware Court, directors have the responsibility to have a thorough and complete valuation analysis conducted by objective parties, such as, third party, like investment bankers or valuation firm. And this was actually the result of the Smith and versus Van Gordon decision, right? So that was the outcome of this decision, that the directors need to have a thorough and complete evaluation of the company, right? That was part of their duties. So in the wake of this decision, the demand for fairness opinion rose significantly, right? So fairness. So if you have gone through filings, right, in this semester for a couple of deals, you will see that there is a section in the merger filing called fairness opinion, or opinion of the financial advisor, fairness opinion. Well, such opinions might help get directors off the hook, meaning that it might help, avoid the lawsuits from the shareholders, but they also have their own issues, right? The issue is that, it's almost like the judge is the player itself, right? Because the firms such as investment banks will issue fairness opinion involving transactions from which they stand to profit, right? For example, the acquirers or the target's financial advisor is Goldman Sachs, right? But on the other hand, the target company talked to the Goldman Sachs in order to seek a fairness opinion, right? No, the judge becomes the player itself, right? So then it's usually not very, there is agency conflict there, obviously, right? So, if you're gonna profit from this transaction, of course, you're going to say the offer is fair, right? Just to make the transaction more smooth. So when we conduct the valuation, there are other alternative like benchmark value we can consider, right? These values, they are readily available measures for the valuation for the firm value. But I mean, we will typically do a valuation analysis, but these for benchmark value, we also will consider when we do the valuation analysis, right? So the four benchmark are book value, equity value, enterprise value, and liquidation value, right? These are the four benchmarks. And what is book value? Book value is the per share dollar value that would be received if the assets were liquidated for the values at which the assets are kept on the books, right? Minus the monies that must be paid to liquidate the liabilities in the preferred stock, right? So it only reflects the values at which the assets are held on the books, right? So one use of book value is to provide a floor value with the true value of the company being some amount higher, right? And the sales price of companies can be expressed as multiples of book value, right? As these multiples tend to vary by industry. So this is the book value. Also, equity value and enterprise value, right? Equity value is the value of the ownership interest in the businesses, right? And then, in a company, this value is usually represented by the value of the stock. So remember, there's a distinction between the value of the company and the value of the stock, because value of the stock is only the value of the equity holder, right? But in a company, normally you will have leverage, right? So then you need to also calculate the value of the bondholder, right? If you sum up debt and equity holders' value, then you get firm value, the firm value, right? But equity value is just the value for the equity holder. So the book value of the equity reflects the value that is derived from the balance sheet as the difference between the book value of assets and liability. That is the book value of the equity. And enterprise value is the value of the entire businesses, right? It reflects the combined value of the claims of equity holders and debt holders, right? That is enterprise value. I mean, in other words, that's like the firm value. Finally, liquidation value, right? Liquidation value is another benchmark of the floor value. Basically, it's a measure of the per share value that would be derived if the firm's assets were liquidated and all liabilities and preferred stock as well as liquidation costs were paid. Right? So it's the measure of the per share value that would be derived if the firm's assets were liquidated. Remember, it's liquidated. And all liabilities and preferred stock as well as liquidation costs were paid. So now let's start the DCF model. So to start the DCF model, we first talk about how to value a project, just basically, right? We need to use the net present value formula, right? So, I mean, basically, the idea is that what is the net present value of a project? It's basically the initial investment, right? That is to be deducted, and then plus the present value of all future cash flows generated from the project. Right? That is the net present value of the project. I mean, the NPV rule was very, very often used to judge whether a investment project is profitable, right? And then in merger acquisition, it was used. I mean, the basics of the DCF model, it was just like NPV formula, right? It was also used to value a company, right? So basically, you have the present value of the future cash flows generated from the project, or the future cash flows generated by the company, right? Then the net present value is the present value of the future cash flows minus the initial investment. So this number is always negative, right? So suppose you invested several hundred thousand and get a safe return of 800,000, right? Then you can calculate the present value using this formula. 800,000 divided by 1.07. Here we assume that the discount rate here is 7%. That's why it's divided by 1.07, right? And then basically you invested 700,000, so the NPV is 47,664, right? So in that case, the opportunity cost of capital is the return forgone by not investing in financial markets. Right? Again, this opportunity cost of capital is very important because in our estimation of the firm value, we always gonna need to calculate this or estimate this cost of capital. And again, this is the opportunity cost of capital, right? It is the opportunity cost, or it's the return that is given up by not investing in the financial markets, right? So why is the return forgone, right? It's because the investors, the equity holder and the bond holder, they don't have to give their money to you, right? They don't have to lend the money to financial manager. They can always use the money and invest in the financial market and get alternative return, right? So that's why if you need them to lend the money to you and they're satisfied with the return, then you need to basically offer them a return that they can get elsewhere at least, right? So at least you need to offer them a minimum return that they can get elsewhere in the financial market, right? That's why it's the opportunity cost of capital. So more broadly, if you want to value a stock of the company, right? Then the future cash flows to the owner of a share of the common stock are basically the future dividends per share that the company will pay out, right? So here, the present value of a share of the stock equals the present value of expected future dividends per share, right? So if you have two periods, then it's basically, this is the cash flow you get in the second period, right? Because this is the dividend you get in the second period. This is the capital gain, basically, right? Because if you hold a stock this year, you're gonna sell it next year, right? This is the cash flow next year minus, right? This is the cost I mean, this part is capital gain, right? So that's why this is the capital gain. This is the dividend gain, right? So that's why this is the expected return. Right? And the price, then it could be written as, this is using the NPV formula, right? So this is the cash flow you're gonna get next year, which is the dividend plus the price you're gonna get, because keep in mind you're gonna sell the stock next year, in which case you're gonna receive P1, right? And then discount it to the present, right? Using the discount rate K, right? So the dividend discount model, it's basically a kind of extension of the NPV formula. And it's a first step towards the DCF model. Basically, it applies to any company if you want to value the value of the common stock of a company. Right? So in general, for a holding period of H years, we can write a stock value as the present value of dividends over the H years, right? Plus the ultimate sale price, PH, right? And basically that equals, so that could be written as P0 plus all the future cash flow, right? Each period's dividend. And in the last period, it is PH plus PH, right? Because we assume that in the last period, you sell the stock. So that's very similar to your bond valuation, right? Because if you buy a bond, you actually receive bond like payments each period, right? You receive coupon payments each period. And the key differences in the case of stocks are the uncertainty for dividends, right? Because I mean, you can commit to paying dividends, but you don't know whether that commitment is always true. Right? And also in the valuation of a stock, there's no fixed maturity date, right? I mean, if you buy a 10-year bond, you know the horizon is 10 years. But if you buy a stock, you don't know the horizon. You can sell tomorrow. You can sell in 3 months. You can sell in 1 year. There's no fixed maturity date. And also, you don't know the final sale price, right, at the horizon dates, right? Meaning that, suppose if you sell the stock in a year, you don't know the final sale price you're gonna get. Right? That's the major difference. Now, if you have many periods like infinite horizon, then this cash flows go forever. Right? Now, what is the K here, right? Remember, we are
we are valuing equity, right? We're valuing a stock. Therefore, this discount rate K is the market cap rate or cost of equity capital, right? Later, we're going to talk about cost of debt, right? But here, we're going to first start from the cost of equity, right? The evaluation, how do we estimate this discount rate, right? We typically use the CAPM model, the capital asset pricing model, to estimate the cost of equity. Because this cost of equity is also the required return, right? Like we just talked about. What is the discount rate? It's the return forgone by not investing in the financial market, right? So basically, the CAPM model gives the required return, right, which could be written as the risk-free rate plus the beta, right? Beta is very important. Beta here measures the sensitivity of a stock to the market risk, right? So this is the sensitivity beta, right? That's why it's a risk measure times the difference between market return and risk-free rate. So this one is the market risk premium, right? And if you move this risk-free rate to the left-hand side, that says the excess return of a company is beta times the market risk premium, right? It's proportional to market risk premium, right? And this beta can vary. It can vary from firm to firm, right? Some firms they can move with the market a lot. Some of the firms they can move with the market very little, right? So therefore, there's variation in terms of this beta. And if the stock is priced correctly, this K is equals the expected return, right? So an underpriced stock basically will provide an expected return greater than this required return predicted by this model, right? So this is underpriced stock. So let's look at a numerical example. Suppose this risk-free rate. So what is the risk-free rate? The risk-free rate is basically a rate of return that with no risk, right? So for example, the return on a treasury bill, right? And this EM minus RF, this is the market risk premium, right, 5%. And the beta, the risk measure is 1.2. Right? So therefore, according to CAPM model, this K will be equal to the risk-free rate plus 1.2 times 5%. That is the market risk premium. That total equals 12%. So then we're going to briefly talk about the capital asset pricing model. It is useful because we need to estimate the cost of equity, right? And then one common way to do it is to use the CAPM model. Right? So what we do is that we first estimate beta, right? Because that's the risk measure, and then we can calculate the cost of equity. Okay? So, and then how do we usually calculate beta? We usually use regression approach, right? Basically, let's say we use 5 years stock return data, right? And then we use regression analysis, right? Which you should be already familiar because when we calculate the required, so when we calculate the CAR, the cumulative abnormal return, we first run this capital asset pricing model, right, to get a beta, right, and then we get a normal return, right. So that's why it should be already familiar to you, right. So then we can first estimate beta and then cost equity, right. So then this is the usual way, right. And then there's also other ways, right. For example, one of the simplest methods is to calculate the historical rate of return, right, for the stock over a given period, like 5 to 10 years, right? Another is like we talked about, use the capital asset pricing model. And this beta measure actually allows us to consider the riskiness of the company and then to use the risk level to determine the appropriate rate of return on the company's equity. This is the formal definition of this capital asset pricing model, right? Again, this is the rate of return on equity will be equal to the risk-free rates plus the beta, right? Beta is the risk measure times the market risk premium, which is the market return minus the risk-free rate, right? Right, the risk-free rate, again, is the treasury bill, right? So that is the return on the treasury bill, right? And usually when you calculate it, it's equal to 0, right? Because it's very, very safe. So let's turn to capital pricing model for a very brief moment. Basically, the Sapien model is trying to answer the question that investors, they want to be compensated for risk, right? And then what is the relevant risk that investors act this way, and given that they can invest in many securities, right? That's why Sapien model actually proposes that in order to measure riskiness of a security, the best way is to look at a covariance with the market portfolio, not the variance, right? Meaning that the contribution of this company in the market portfolio, basically, right? So securities with high covariance or high risk have to pay a high expected return because they are bad security, right? So the idea of the Sapien model is that if you have high beta, that means you can move with the market a lot. And these are bad stocks because suppose there's a market downturn, right? These stocks will not pay you, right? Because when the market goes down, they go down. When the market goes up, they go up, right? They don't offer you protection when the times are bad, right? So that's why if you have a high covariance stock, and then you have your high expected return, so that means if you're high covariance, the beta is high, right? If the beta is high, the return is high, right? So that means the company is very risky. Right? That's basically the idea. And beta is typically derived from regression analysis where the variability of the market return is compared with the variability of securities return, right? So if you still remember in our analysis of the cumulative number return, we regress individual stock return on market return. All right, and then to get this beta. And it is defined by this formula, right? It will be equal to the covariance of a company stock with the market return divided by the market risk, right? The variance of the market return. So for example, if you decide to use a market risk premium of 7%, the risk-free rate is 1.1%, then the resulting estimate for the cost of equity will be the cost of equity equals risk-free rate plus beta times the market risk premium, right? Ultimately, it will be equal to 9.8%. Yeah. So basically, when we calculate this cost of common stock or cost of equity using this Sapien model, we need to decide the length of the period used for historical data and also the specific market index, right? For example, we can use SP 500 market index. We can also use SP 1500, right? And also, when you decide the time periods, the frequency used, right? You can use daily return, you can use monthly return, right? And also the specific risk-free rate used, right? So the Sapien model basically can be adjusted to try to come up with an equity rate that is relevant to non-public targets and ones that have other risk factors such as smaller size. Okay? This will come up briefly in a little bit. And for non-public targets, the beta might be derived from comparable public company. Okay? And now, remember, what we are dealing with previously is we look at this beta, right? And typically we estimate this beta, we assume this is the cost of equity. So basically we assume the company is fully financed by equity, right? But now, when the company has debt, there's also another set of beta, right? So remember, what we just calculated, it's just equity beta, right? We're just talking about the cost of common stock, right? We haven't talked about cost of debt yet, right? That's why if we want to calculate the company's, let's say, cost of capital, right? Cost of capital basically is the discount rates that we use to discount the cash flows to get a fair valuation. In our case, we need to use the we need to use the overall beta of the company, which has the debt part, also the equity part. All right. So that's why we need to use asset beta in this case to calculate the beta of the overall company. So in that case, a firm's asset beta is equal to the beta of a portfolio of all firms' debt and equity. Right? Remember, a firm is a portfolio of debt and equity. Now it has debt, it also has equity. Therefore, if you have equity beta, of course, you also have debt beta. Right? And then the firm's beta will be the weighted average of the debt beta and equity beta, and the weight here as the debt ratio and equity ratio. And the asset beta we're going to calculate will be the estimate of the average risk of firm. Right? Now suppose this debt ratio, debt to value ratio is, this V is value of the firm, right? The value of the firm equals the debt plus equity, right? Suppose that debt ratio is 0.3, and then the debt before the refinancing has a beta of 0.1, debt beta 0.1, and then the equity has a beta of 1.1. Then we can use this formula to calculate the asset beta, which is equal to 0.8. And suppose that the firm issue an additional $10 of the debt and then use the cash to repurchase 10 of the equity. All right. Then we need to recalculate the equity beta, yeah, because the idea is that if you borrow more, you make the equity more risky, right? You make the equity more risky because you increase the default risk, and that default risk is going to be translated onto the equity, right? So after the refinancing, the risk of the total package isn't affected, right? This is our assumption. Then we can use the formula to calculate the equity beta. Yeah. This equity beta will become 1.27, right, which is higher than before. Basically, the idea is that financial leverage does not affect the risk or expected return of firm assets, but it increases the risk of the common stock. Right? So why do we need to talk about this beta with different debt level? The idea is that, I mean, we see this quite often, right? Before suppose you are leverage, right? Suppose you are engaging in a leverage buyout transaction, right? Then obviously the debt level before and after the merger is going to change. It's going to increase essentially, right? Because we say that in a leverage buyout deal, what happens is that the firm borrow a lot to finance the acquisition. The acquirer borrows a lot to finance the acquisition. Therefore, the debt ratio before the merger will definitely be lower than the debt ratio after the merger, right? So now, if the debt ratio changes, then you need to re-estimate your beta, right? Because your risk profile definitely changes, right? So that's why we need to adjust the beta under the new capital structure, right? For example, after the merger acquisition. And because this is important, because if we get a new beta, we will be able to calculate the new cost of equity, and finally we will be able to calculate the new cost of capital, and we will be able to estimate the new firm value after the merger acquisition. Right? That is the idea. So we're gonna have the two kind of beta, two steps here, right? First step is that we need to get unlevered beta, right? This is the beta without any financial risk, without any debt level. Suppose that the company is fully financed by equity, like 100% stock. What is the beta? Then we need to calculate the relevered beta, right? Because the debt ratio changes, right? There's a new debt ratio. So in that case, after we find this unlevered beta, we need to relever the beta to the real or ideal capital structure, right? So this work will change as well, right? This is the weighted average cost of capital. Okay? So the process is essentially we need to first get unlevered beta, then we need to get relevered beta. And then if we get a relevered beta, we'll be able to calculate the new weighted average cost of capital, right? We will talk about this concept in a little bit. Okay? So this is a quick formula for how to calculate this unlevered beta and the relevered beta. Right? So basically, this is the asset beta if we consider tax, right? So remember previously we don't have tax, right? Now suppose in reality there's also taxation here, right? Now in that case, the new asset beta will be the debt beta times 1 minus d times the times debt ratio, right? Plus the equity beta times the equity ratio, right? Here the value equals d plus c, and we assume that debt beta equals 0, right? Now we will get this unlevered beta first, right? Will be equal to the levered beta. So remember, this is the original debt ratio and our original beta, right? Suppose originally the debt ratio is 10%, and after the transaction, the debt ratio increases to 30%. Then this 10% is what you need to use initially, right? And then this is the beta you need to use initially. And then this relevered beta is beta E prime, right? Will be equal to this unlevered beta times 1 plus 1 minus t times the new debt ratio. Right? This is the new debt ratio. Right? So don't worry if you do not understand until this point, because we're not going to examples so that you'll be know this better. So basically the betas are computed for various companies, right? And then they're called leverage beta, right? So this is what we gonna get, right? So this is from the book basically. This unlevered beta will be equal to the levered beta minus 1 plus 1 minus t, and that's divided by equity, right? So this is what we have here. So in broader sense, right, to the estimated return, additional risk premium could be added, right? For example, a small company might have additional risk premium, right? For example, size risk premium, right? You could add another factor here, right? And then we can get a price of a firm stock will be equal to the dividend paid in period T divided by KE, the cap rate of the company. This is like the discount rate, right? Minus the G, the growth rate of the dividends, right? This is essentially the dividend discount model, right? That we talk about. So let's go back to a little bit. So if you look at this dividend discount model, right? So now you can see if we assume there is a constant dividend growth rate, right? Then this will be like D times 1 minus G, right? This will be D times 1 plus G to the power of 2. Then this will be D times 1 plus G to the power of 3, right? So then we can summarize the formula, transform the formula so that we can calculate the price in this way. Let's go. All right, this price will be equal to the dividend paid each period divided by K minus G. And K is basically cost of equity. G is the growth rate of the dividend, right? If we assume there's a constant growth rate. And then we can manipulate the equation to solve for this market cap rate or cost of equity. It will be equal to dividend divided by initial price plus G. All right? And basically a simple guideline to derive the cost of equity is to consider the rate of equity is generally 4% to 6% higher than the rate of debt. Yeah. Again, this is a simple, quick way to get cost of equity, right? What we introduced earlier, that is to run a regression to get a cost of equity, that is a more common way to calculate. Right? And here, the rate of debt, the cost of debt may be clear if the company does not have many types of debt, right? So basically, in this case, if the debt rate is given and the 4% to 6% can be simply added to derive the rate for equity. That's also a very quick way to get a cost of equity. Right? If you have the cost of debt, you just add 4 to 5%. But normally we don't use this approach, right? Because it's not very precise. Now, in order to calculate cost of capital, remember, cost of capital has two components, right? One is cost of debt, the other cost of equity, right? What is cost of equity? That is the required return for equity holder. What is cost of debt? That is required return by the debt holder, right? So here, the after-tax debt rate reflects the true cost of debt, right? But if you have learned corporate finance, you will know that if you have the tax, if you have higher debt ratio, right? If you borrow more, you're going to enjoy the tax benefits, right? Because if you have a leverage, your taxable income will decrease, right? Because your taxable income is the income after you pay the interest rates, right? Now, if you borrow more, you pay more interest, right? So then, suppose we have the same earnings before interest and tax. Then, in that case, the company with a high leverage, the company with a high interest burden will have a lower taxable income, therefore lower tax burden, right? So then this is the after-tax cost of debt, which will be equal to the cost of debt, the pre-tax cost of debt times 1 minus t. Right? T is the tax rate. Now we have the cost of debt and also the cost of equity. Right? Remember how we get it, right? Cost of equity, there are 3 ways, right? For example, first, linear regression. Second, there are actually 4 ways, right? First, linear regression. This is the most recommended ways. Second, you can get a historical rate of return, right? That's a very quick way, but very rough. Third, you can use the dividend discount model, right, to calculate it. Fourth one, you can also calculate, for example, use the calculate the cost of equity as 4 to 6% plus the cost of debt. That's a rule of thumb, which also very not precise. Right? So we also talk about how to get a cost of debt. Right? Basically, cost of debt is usually given, right? It's usually derived from the credit rating of the company. Right? So now to get a cost of capital, it is defined as the expected return on the portfolio of all the company's outstanding debts and equity security. Right? The appropriate discount rate for the firm's average projects is basically cost of capital. Okay? Suppose the company has no debt outstanding, then the company's cost of capital is just the expected rate of return on a firm's stock. Right? And formally, we can write down the cost of capital as the weighted average of cost of debts and the cost of equity, right? But here the weight is the debt ratio. Now you can use the debt ratio times the cost of debt plus the equity ratio times the cost of equity. But remember, this is pre-tax, right? This RD is pre-tax. So the cost of debt is usually less than the cost of capital, right? Because debt is safer than the assets, right? Because debt is usually safer than the equity, right? Then if you do the average between the two, cost of capital is somewhere between cost of debt and cost of equity, right? So cost of equity is usually higher because equity is more risky, right? Because if you buy stock, that is usually generates higher return than if you buy a bond, right? That's a simple intuition. So this is cost of, and if we consider tax, we can define after tax weighted average cost of capital, right? Which will be equal to the required return on debt times the 1 minus the tax rate times the debt ratio plus the cost of equity times the equity ratio. All right. Again, after tax cost of debt captures the value of the interest accrued. Right? Again, just remember the formula here, right? So after tax WACC is the cost of debt times 1 minus t times debt ratio plus cost of equity times equity ratio. Right? Now let's look at a very simple example. Right? This is a company called Sangria. This is the book value. This is the market value. Right? Now we can calculate their WACC, right? Suppose the cost of debt is 6%, cost of equity is 12.4%. The tax rate is 0.35, and the debt ratio we can calculate here. That is 500 divided by this one, right? 1,250, right? Which is 40%. Equity ratio is 60% in that case, right? Then we can calculate the WACC using the formula here. Right? This is a simple way to calculate WACC. Now that we know how to calculate WACC, we can use WACC to value a project. All right. Suppose the pre-tax cash flow of a company is 1.731 million, right? And then the tax rate is 33%, right? Now the after-tax cash flow is 1.125, right? Just using this pre-tax cash flow times 1 minus 35%, right? You get this after-tax cash flow. Now the value of the interest tax shields is picked up. Now it's higher after tax cash flow, but in a lower discount rate, right? Now you can see, like we talked about, right? If you have higher leverage, if you borrow more, you have to pay less tax, right? Because tax is based on your after interest payments, but before tax income. So in our case, suppose this is the initial investment, 12.5 million, right? Then this is your after-tax cash flow. Then suppose the discount rate is 9%, right? So in our case, the rate of return of investment will be the WACC, right? We can calculate. Then we can use the NPV, right? Calculate NPV. NPV will be equal to 0, and then the rate of return here this 9% is the WACC, right? And if the NPV equal to 0, then the return to the equity investor must be equal to the cost equity, right? Which will be equal to 12.4%. That is the cost equity. How do we get it? We get it from here, right? And how do we get a WACC? We calculate it here. WACC is 9%, right? This is how we get this 9%. Now we can begin to talk about firm valuation, right? Then to value a firm, there are many ways, right? We can value the equity, right? We can also value the firm, right? If we want to value a firm, we essentially are valuing the entire businesses, right? And if we value a firm, that essentially has two components, assets and the liability, right? So here, the assets include existing investment, general cash flow, or like also including long-lived fixed assets and the working capital assets, right? And also gross assets, right? Liability side, we include debt, right? Long-term debt, short-term debt, and these debts are in many cases tax deductible, right? Just like the reason I just mentioned, right? If you have a high debt ratio, your taxable income will be lower, hence the tax benefits will be higher, right? And there's also equity here, right? Equity is the residual claim on cash flows, right? So basically, if we want to value equity, we are valuing this part, right? So it's the value of just the equity claim in the firm, right? In the businesses, right? Now, if we want to value this firm, we can use the DCF valuation model, right? It's a generic DCF valuation model, just like we talk about. So the value, it could be the value of the firm, it could be the value of the equity, right? Depending on your choice. If we value a firm, then the cash flow of the cash flow in consideration is the pre-debt cash flow, right? If we calculate the equity, we need to take out the debt, right, from the cash flow. Right? Now we also need to assume a growth rate, right? So there's an expected growth rate here, right? So if you want to do firm valuation, you need to estimate the growth in operating earnings. If you want to estimate the equity value, then you need to assume the growth in the net income or EPS, right? Now, basically, the general framework for valuing a firm is that we assume there's an initial periods of high growth, right? Initial like 1, 2, 3, 4, 5 years growth, right? And then after these 5 years or 3 years, right, the company enters the stage which is more stable, right? Then the firm is in this stable growth stage, right? In that case, growth will be at a constant rate forever, right? For example, in the initial 5 years or initial 6 years, the growth rate might be 10%, right? But after the initial stages, after the 6 years, the company will grow at 5% forever, right? This is so in our case here when we calculate so here we need to calculate termination value here, the terminal value here. That is at the end of 6 years, for example, at the end of 5 years, for example, right? So this terminal value essentially is the value of the firm from the 6th year and on, right? That is the idea, right? And then basically when we calculate the firm value, we sum up two components, right? One is the terminal value, which is the value of the firm or value of the equity from the 6th year and on, right? From the 6th year to forever, right? And then the second part is the value of the firm or equity in the first 6 years, right? This is the general way we do it. So this is the equity valuation, right? So you can look at it because we're going to focus on the firm valuation. So basically, when we calculate the firm valuation, we're gonna the present value we're gonna calculate is essentially the value of the entire firm. Therefore, it reflects the value of all claims on the firm, right? Not just the equity holder, but also the equity holder and debt holder, right? So basically, to go from firm valuation to equity valuation, right, you need to do a couple of things, right? So you need to subtract out the value of the long-term debt. You need to subtract out the value of the all debt, subtract the value of any debt that was including the cost of capital calculation, right? Also, and also you can subtract out the value of liability in the firm, right? So basically, what you need to do is just this one, right? Subtract out the value of the debt. Right? Remember what we. So let's look at. Right? Remember, everything in total, that is firm value. And this here, this is the equity claim, right? This is the equity valuation, the value of the equity. Now the rest is the value of the debt. Therefore, you just need to take out debt. You just need to take out debt, then you get equity value, right? This is what you need to do. Now let's look at one example, right? Suppose that you're analyzing a company with the following cash flows for the next 5 years, right? And we're gonna do two things, right? This is the cash flow to equity, then this is the cash flow to firm, right? Now, the difference is the interest expense, right? This is the debt part. Right? Now, suppose the cost of equity is 13.625%, and then the firm can borrow long-term at 10%, right? So this is the cost of debt, right? So the tax rate for the firm is 50%, for example, right? Suppose the current market value of equity is $1,073, right? And then the value of the debt is 800, right? Now let's look at the two methods of calculating the value of equity. All right. There are two methods here. First one, we can discount the cash flow to equity at cost of equity, right? To get the value of equity, right? Remember, you need to use cost of equity to kind of discount cash flow to equity, right? You need to use weighted average or cost of capital to discount cash flow to the firm. They are very different, right? And the use of it should be matched, right? And now here the cost of equity is 13.625, right? Now we can calculate the value of the equity, right? So this is cash flow to equity used, and then if you use the cost of equity here, you get the value of the equity, right? This is a direct way to get a value of equity, right? There's also second indirect way to get it, right? For example, you can discount cash flow to firm and the cost of capital to get a value of the firm, right? For example, first calculate cost of debt, which will be equal to this pre-tax rate 10% times 1 minus the tax rate, right? Then the cost of debt is 5%, right? Now we get it. Now we have the cost of debt. Also, we have the cost of equity, right? Now in that case, we can calculate the cost of capital, which will be the weighted average of the two, right? 13.625. That's the cost of equity, right? This is the debt ratio, right? This is the equity ratio. Sorry, this is the equity ratio. This is the debt ratio, right? Times the after-tax cost of debt. So now you get cost of capital, then you can use it to discount the cash flow to firm, right? Remember, these two should be matched, right? Then we get a present value of the firm, right? So that's why the value of equity now finally should be firm value minus the market value of debt, right? Because these two are the same, right? So again, this multiple choice question, remember you need to subtract out the value of all debt, right? This is the thing you need to subtract in order to have equivalent conclusion from the two approaches. Right? Now, the steps of using the DCF approach to get the value of the firm is that you first estimate the discount rates or rates to use in the valuation, right? For example, the discount rates can be either a cost of equity or a cost of capital, right? If you want to value the equity, you use the cost of equity. If you value a firm, you use cost of capital, right? And discount rates could be nominal or real, right? If you use the real discount rate or the real interest rate, you need to deflate the cash flows in your numerator, right? Again, these two things should be matched, right? If you use nominal interest rate, then you need to use nominal cash flow. Right? Also, discount rate can vary across time, right? Just like we said, before the merger could be lower, after the merger could be higher, right? So it could be basically the discount rate here. So what's basically it is, right? It basically reflects the overall riskiness of the firm, right? That is what it is, right? If the company is more risky, of course the cost of capital will be higher, right? Because now all the debt holder and equity holder, they will require higher return, right? Because the company is more risky, right? They need to compensate it for this higher risk. Therefore, the cost of capital must be high, right? And this is the first step. Second step, you need to estimate the current earnings or cash flow on the asset, right? So if you want to estimate the value of equity, you estimate the cash flow to equity, right? If you want to estimate the cash flow to firm, you need to estimate the cash flow to firm, right? Now, basically, we can estimate the future earnings and the cash flow on the firm being valued, right? Basically, we need to assume there's a growth rate. I mean, because there are many periods, right? We cannot, I mean, look at the cash flow each period, right? In general, we estimate a expected growth rate in earnings, right? Now, this is, so again, we have two stages, right? The initial stage is high growth stage, right? Like 1 to 5 initial years after the merger, for example, right? Now, after the 5 years, we're going to enter into a stable stage, which we're going to assume a forever growth rate or stable growth rate, right? So in that case, when you estimate when the firm will reach the stable growth, right? It's in 3 years, it's in 5 years, or it's in 9 years, right? And then what characteristics will have, right, when it does, right? For example, maybe in the initial high growth stage, the revenue grows by 8%, right? In a stable stage, the revenue will grow at 3% per year. Right? This is all the assumption you need to estimate before we do the firm valuation. This is also investment bankers always do when they do this valuation exercise. And then finally, choose the right DCF model for this asset and evaluate, right? This is usually the cash flow, I mean, the MA valuation model we typically use, which is called the free cash flow to firm model. Right? So the present value of the firm will be equal to the free cash flow in the initial high growth stage, right? From period 1 to period H, right? This is the initial high growth stage. After this high growth stage, we enter into a stable growth stage. All right. Now, in that case, we need to have this one. This is the terminal value, right? Or horizon value. These two names are interchangeable. Horizon value or terminal value. These two names are the same thing, right? Now, this PVH, this is the value of the company from the periods, from the first period in the stable growth stage to forever. Yeah, this is the horizon value. Now, there you need to discount this terminal value or horizon value to the present, right? To the present, right? So that's why this PVH will be equal to, right? This is the free cash flow you're gonna have in each period in the stable stage, right? Discounted by, this is the WACC, right? Minus G. My G is the growth, G is the stable growth rate, right? Now remember, in like real life, this WACC in the stable stage might actually differ from this WACC in the first stage, in the high growth stage, right? Now then, in that case, you need to apply this new WACC here, right? Right. For example, initially the company in the first 5 years, the company is less risky, right? Now, if we enter into the stable growth stage, then the company might be more risky. Now, if the company becomes more risky, then this WACC here that you use to calculate this terminal value should be changed, right? So this is the way to do it. Now, what is free cash flow here, right? Free cash flow is typically the after-tax earnings before interest and tax
minus the net capex, right? And what is the net capex? It is essentially the capital expenditure minus depreciation, right? And minus changing working capital. Right? This is the usual way we calculate this free cash flow. Of course, there's also alternative way, right? So in general, the free cash flow are those cash flow that are available to all capital providers, right? Both the equity holder and debt holder. All right. After necessary deductions have been made for the capital expenditure that are needed to maintain the continuity of the cash flow. Right? So what is the formula? I mean, that's the alternative way to calculate free cash flow, right? Which essentially is the free cash flow will be equal to the EBITDA, which is earnings before interest, tax, right, and the depreciation and amortization, minus the capital expenditure. This is the capital expenditure, right? Minus the change in the working capital, right? And then minus the cash tax paid, right? That is more general. That is more general formula, right? And in our example, we'll look at a simplified formula for free cash flow, but the idea is the same. Yeah. Basically, again, there's alternative way, which is the profit after tax, right, plus depreciation, right? So this part will be equal to EBITDA, right? Minus the investment in fixed assets, that is capital expenditure, and minus the investment in the working capital, right? Changing the working capital, basically. I mean, you can think about that as the new investment. That's why it's the changing the working capital, right? Now let's look at a simple example that uses the model that we just mentioned, right? Basically, the free cash flow is calculated assuming the firm is all equity financed. And basically, we discount the free cash flow at after-tax WACC given the total value. Right? Again, this is the formula that we just see. Right? And free cash flow is different from net income, right? Because income is the return to shareholder after calculated after the interest expenses, right? But free cash flow is calculated before the interest expenses, right? But now you're gonna wonder, right? How are we gonna take into account the interest expenses, right? Because two firms might have two different level of interest expenses, right? The answer is that the fact that the company has a higher debt burden or more interest expenses is reflected already in the weighted average cost of capital, right? Remember, in that weighted average cost of capital, it is the weighted average of the that. So the weight there is debt ratio and the equity ratio, right? So that's why the high or low of the interest expenses are already reflected in the calculation of the weighted average of cost of capital, right? So here, income is calculated after various non-cash expenses, including depreciation. Therefore, we will add back depreciation when you calculate the free cash flow, right? This is the thing we need to do. And capital expenditure, there are no, or investment in working capital, they do not appear expenses in the income statement because they are investment, right? But they do reduce free cash flow, right? That's why when we calculate free cash flow, we need to consider capital expenditure in investment working capital, right? Now in this table, we are calculating a free cash flow of a company, right? The free cash flow here is, if you look at the table, right, it's profit after tax plus the depreciation minus the investment in the fixed assets, right, minus the investment in the working capital, right, just like the formula we just laid out there. Right? So what is 7 here? 7, the profit after tax, what is, right? It is 5 minus 6, right, which is the profit before tax minus the tax, right? That is the profit after tax, basically. Now, if you look at this one, right, initially year 0, right? Now in the first 7 years, we have free cash flow calculated there, right? Then we can also calculate the present value of the free cash flow in year 1 to 6, right? We assume here that from the 7th year and on, there's a stable stage going on, right? Right? So that's why we first calculate the present value of the free cash flow in the years 1 to 6, right? Now, second, we calculate the horizon value in year 6. That is the terminal value, right? Remember the terminal value in year 6, right? Let's look at the table. What the terminal value in year 6, right? and then discounted. Now the present value of the horizon value is 67.6, right? Then the present value of the firm is the sum of these two, right? Now, if you look at this company, right, the sales is, the growth rate of the sales is actually slower and slower, right? If you look at the change, right? It's essentially because the competition is becoming higher and higher in the industry, right? And the cost also increases, right? So here we kind of assume that the working capital grows in proportional to sales, right? This is the assumption we make here. We assume that the working capital grows in proportion to sales. Now let's look at the how do we estimate the firm value, right? Because almost all parameters are already given here, right? Suppose the weighted average cost of capital is 9%, right? Now in the first 6 years, we calculate the present value of the first 6 years free cash flow. Right? Free cash flow is essentially here, right? First 6 years. Using the WACC equaling 9%, we calculate the first 6 years, right? Now we calculate the present value of the horizon value. This is the horizon value essentially, not the present value of the horizon value. This is the horizon value, right? So that is the free cash flow in the year 6, right? Discounted to this is the horizon value starting from year 7, right? This is the second stable stage, right? Now looking from year 6, this is the value, right? That is the free cash flow in the year 7 and on, each period of year 7 and on, divided by the new WACC, which we assume they don't change, right? Which is 9% minus the growth rate. We assume that in the long term, in a stable stage, the growth rate is 3%, right? Now the horizon value will be this number, right? Now finally, we need to discount this horizon value to the current time, right? So 1 divided by 1.9, 1 plus 9% to the power of 6, right? Now the present value of the company will be equal to the present value of the cash flow in the first 6 years plus the present value of the horizon value, right? Now remember this number here is the present value at year H, right? Not at the year 0, right? So that's why we got a firm value, right? Now we can also get a total value of equity will be equal to the firm value minus the value of the debt, right? This is our assumption. We assume that the value of the debt is 36 million. Yeah. Now we get total value of equity is here, right? Now we can also calculate the value per share, which will be equal to this one, right? Minus the number of shares, 1.5 million. That's also our assumption, right? We get a value per share. So the general difficulty here is to estimate a growth rate, right? This is obviously a very difficult task. There are many ways we could do it. I'm not going to expand on it because if we're going to expand on it, we're going to talk about maybe another 2 classes, right? So basically there are 3 ways, right? First, we can look at the past. Historical growth in the earnings could be a good sign, right? The past might be a good proxy for the future. Second, we can look at what others are estimating, right? For example, financial analysts, they estimate growth in earnings per share for many companies, right? Therefore, it is useful to know what their estimates are and then borrow their estimates, right, for example. Also, we can look at the fundamentals, right? Ultimately, all growth in earnings can be traced to 2 fundamentals, right? How much the firm invests in new projects and what returns these projects are making for the firm. Right? Now let's take a break, then we're gonna talk about the example. So in general, when we try to value acquisition, the methodology we use are typically DCF models, but the different steps that we take when valuing acquisition. Because remember, what is acquisition? It's basically a company A and a company B merging into a company, right? Now, what is synergy here, right? Synergy basically, so it must be that the value of the combined firm must be greater than the sum of value of company A plus the value of company B. This is synergy. So therefore, in order to value synergy, we first need to value the company A and company B separately, right, as 2 separate companies. Right? So this is called a status quo valuation. That is, we need to value the company as it is, right, with the existing inputs for investment, financing, and dividend policy, right? There's also something we need to value, which is the control premium. That is, we need to value the company as if optimally managed, right? So this will usually mean that investment, financing, and dividend policy will be altered, right? So that is, suppose that a target management, right, it is replaced by the acquired management, right? That is, suppose that acquired management can improve the firm, right? What is the premium in the target company's value, right? So that is value of the company as if optimally managed, right? We assume that acquired management can optimally manage the firm. Now we're gonna look at one example. I'm gonna show you the evaluation process step by step. So in 1997, Digital Equipment, that's a leading manufacturer of mainframe computer. And at that time, this company was the target of an acquisition bid by Compaq. And then that company was the leading personal computer manufacturer in the world, right? And then the acquisition was partly motivated by the belief that the Digital was a poorly managed firm and that Compaq would be a much better manager of Digital's assets. Right? And in addition, this company, Compaq, expected synergies in the form of both cost savings. So cost savings are typically from economies of scale, right? So we covered this earlier in this class. And high growth, right? High growth is because Compaq will be able to sell to Digital's customer, right? In that case, their revenue will be enhanced. So we first start from the status quo valuation. Right? We look at the value of the target firm, right? So suppose Digital, this company had earnings before interest and tax of 391.38 million in 1997, right? This will be translated into a pre-tax operating margin of 3%, right? And the revenue is 13,046 million, right? And then there's after-tax return on capital of 8.51. Right, this is after-tax cost of capital. Yeah? And then the firm has a tax rate of 36%. Right? Now, because we know that the beta is 1.15, the after-tax cost of borrowing 5%, right? And then the debt ratio is about 10%. And then, therefore, we can calculate the cost of capital as 11.59, right? But of course, we assume that the treasury bond rate, which is the risk-free rate that we use to calculate the cost of equity, is 6%. So this is how we calculate the cost of capital. Right. So again, the procedure is that we first calculate cost of equity, right? Now, if we have the cost of equity, we can do the weighted average, right? Debt ratio times the cost of debt plus cost of equity times the equity ratio, right? Then how do we calculate cost of equity? Cost of equity will be risk-free rates plus 1.15, right? And then plus the beta, the risk-free rate is given here, right? Risk-free rate plus beta 1.15 times the market risk premium. Here we assume market risk premium is 10%, right? So this is how we basically do it. So cost of equity, market risk premium here, we assume it's 5.5%, right? So therefore, the cost of equity will be 6% plus 1.15 times the market risk premium. So the cost of equity is 12.33%. So then cost of capital will be cost of equity times the equity ratio plus the cost of debt times the debt ratio, right, which will be 11.59. And this company, Digital, had a capital expenditure of 475, depreciation 461, and working capital is 15% of revenue. Right? And we assume in the next 5 years, the growth rate is 6%. Right? This is standalone. Now, this is the initial 5 years, they are the initial high growth stage, right? That's why I was using the 6% growth rate. After the year 5, the operating income, the revenue, were expected to grow 5% a year forever. So that's the stable stage. And after year 5, capital expenditure were expected to be so 110% of depreciation, with depreciation growing at 5%. The debt ratio remained at 10%, and the after-tax cost of debt dropped to 4%, right? And then the beta dropped to 1. Now you can see there's a change in the beta and also cost of capital. Yeah, so therefore, the terminal value will be changed as well. The terminal value will be calculated using a different cost of capital as well. Yeah? So the value of the company will be 2,110.41, right? And then this is the table. Now I'm gonna show you how to calculate it. This is in this spreadsheet. Now let's first look at the status quo valuation, right? Now, there are 2 stages, right? Remember, again, do not forget, there are 2 stages. In the first stage, market risk premium is this, beta is 1.15, right? Beta is high in the first stage. And the debt ratio is the same across 2 stages. Risk-free rate is the same across 2 stages, right? The only thing is that a company is more risky in the first stage. After year 5, the company becomes less risky, the beta is 1, right? Now, based on those information, we can already separately calculate the cost of capital for the 2 stages, right? You can look at it from the kind of equation. It's just the equation that we talk about today, right? Now let's go calculate the first 5 years and then also the horizon value at the year 6, right? Now, first of all, EBIT pre-tax margin is already given. That's it. That's in the initial year, right? After tax return on capital, it's already given 8.51, right? And tax is 36%. Capex depreciation working capital it is also given, right? So here, working capital is 15% of the revenue, and revenue net capex, which is capex minus depreciation, it's 6%, right? EBIT is 6%. So they all grow at 6%. Now, what is our free cash flow? Free cash flow is the sum of the 3 components. After-tax EBIT plus net capex plus changing working capital, right? What is net capex? It's capex minus depreciation, right? Now let's calculate the 3 components separately, right? So the after-tax EBIT is basically the revenue times the pre-tax margin, right? Times the growth rate, right? And remember, this is the initial year 0, right? The revenue grow at the 6%. Therefore, in year 1, the revenue already grow at 6%, right? And then times 1 minus the tax rate, right? Now you get EBIT, after tax EBIT in year 1. Now the tax rate doesn't change. Therefore you can see using the 6% growth rate, we can calculate the after tax EBIT in the first 5 years, right? Now net capex. Net capex is capital expenditure minus depreciation, right? But we know that net capex grows at the 6%, right? So therefore, we first calculate the net capex in year 0, and then, so in year 0, it's D7 minus D8. It's capex minus depreciation, right? Times the growth rate, 1 plus B4, 6%, right? Now, every year of the first 5 years, they have the growth rate 6%, right? And then the change in the working capital is this one, right? So changing working capital is, the change in working capital is for example, it's the year 1 working capital minus the year 0 working capital, right? It's this year's working capital minus last year's working capital, right? So it is the 15% times the revenue in year 1 minus the 15% times the revenue in year 0 initially, right? So this is the change in working capital in the year 1. Right, so we know that the revenue grows at a 6% every year, right? So then every year you need to apply this high growth rate of revenue, right? Then we get change in working capital, right? Now, from in year 6 and now, everything has changed, right? So we have entered into a second stage, which is more stable. Now, in our case, there will be a new so in our case we have revenue here, right? So now let's look at the new growth rate. The new growth rate. Let's go back to the. So let me just check the. So after year 5, capital expenditure, they were expected to be 110% of depreciation, right? And depreciation grows at 5%. And after year 5, operating income and revenues were expected to grow 5% a year forever. So now let's go back to here, right? So it's gonna be 5%, right? So it's gonna be 5%. So these three is 3%. So again, the revenue, sorry, the after tax EBIT, it will be 18, right? So you can see this already applies the 5% growth rate, right? Right? Times the pre-tax margin 3% times the 1 minus tax rate, right? Now, capital expenditure it will be equal to 100 because they grow at 110%, right? So that's why net capex will be 1.1 depreciation minus depreciation, right? And then it will be 10% times depreciation, right? So what is depreciation? Depreciation is basically this number, 461, right? Will be 461 times the 1, so they grow at 6%, right? So this is the initial depreciation, right? First, we need to apply. So first, we need to get depreciation in the 5th year, which is 1 plus 6% to the power of 5, times. Remember, depreciation grows at 5% from the 7th year now, from the 6th year and on, right? So you need to apply the 1 plus 5% growth rate, right? Then times 0.1. 0.1 is here, right? This equation here. Then we get net capex in year 6, right? And also changing capital in year 6, right? Now because so you can see this number, right? It's derived from the 15% times the revenue in year 6 minus the revenue 15% times the revenue in year 5, right? Now we can get free cash flow in year 6, right? Now we have already get the free cash flow in the first 5 years. And then we can calculate the terminal value. How do we get terminal value? So that is the free cash flow in year 6, right? Divided by the new cost of capital in the stable stage minus the growth rate. Right? This is the terminal value. Right? What is the new growth rate? It's K9, which is new cost of capital is 10.95, right? Minus the growth rate, 5%, right? You get this terminal value. Now, do not forget to discount this terminal value to the present time. To now, right? This is what we get, right? So this is we discount this G17 to the present time, right? Now we also need to add this F15, right? We also need to add the cash flow in year 5, right? Remember, this is the discount cash flow of year 5 cash flow. This is the present value of the terminal value, basically, right? I will get this, right? Then, if you sum all these things up, right? The first 5 years cash flow plus the present value of the terminal value, now we get this number. Right? This is the status quo valuation. Right? Okay, we have shown this. Now let's go back to the slides. Now this is the status quo valuation. Now the second part is the value of the control premium, right? This already, you can look at this, right? The value of the control is the value of the firm that is optimally managed minus the value of the firm with current management, right? So in our case, the digital will raise the debt ratio to 20% and the beta will increase, but the cost of capital will decrease, right? So basically, we assume that if the company is optimally managed by the compact, the debt ratio will increase. So that's why the beta will also increase, right? And the new beta will be 1.25, right? Because the unlevered beta is 1.08. The debt to equity ratio is 25%, right? Then using this new beta, we can get new cost of equity, right? And we can calculate the new after-tax cost of debt, which is 5.25%. So in that case, you can see the new cost of debt is higher, right? The cost of capital then will be 11.35%. And we also assume that the digital will raise the return on capital to 11.3%, right? This is the cost of capital. And the reinvestment rate remains unchanged, but the expected growth rate will be higher, right? Under, let's say, compact's manager's hands, right? It will be increased to 10%. Pre-tax margin will also increase to 4%. Previously, it was 3%, right? Also, after year 5, the beta will drop to 1. The after-tax cost of debt will decline to 4%, as in the previous example, right? Okay, with all the new information, let's go back to the Excel, right? So this is the value of the control, right? Now, remember, before we calculate the value of the control, we need to adjust our beta, right? Again, we need to adjust our beta. So first, the task is calculating new beta, right? The pre-merger debt ratio is 10%. Post-merger debt ratio is 11.11%, right? Now, post-merger debt ratio 20%, right? This was the assumption, right? The post-merger debt to equity ratio is 25%, right? It just transformed from here, right? Now the equity beta is 1.15, right? The tax rate is 36%. The risk-free it is still 6%. Market risk premium it is still 5.5%, right? Now we're gonna use the formula we talked about earlier, right? First, we need to get unlevered beta. Then we need to get a relevered beta, right? Because now remember the capital structure has changed, right? It goes from 10% debt ratio to 20% debt ratio. Therefore, we need to derive the new beta as well as the new cost of capital, right? Now, first calculate the unlevered beta. Use the formula on the slide that we just went through, right? What we do is that we use this beta, equity beta, right? Divided by 1 plus 1 minus the tax rate, right? Times the pre-merger debt to equity ratio, right? Now we get unlevered beta. Now, after we get an unlevered beta, we need to get a new beta, right? Relever the beta, right? That is the unlevered beta times 1 plus 1 minus tax rate times the new debt to equity ratio after the merger, right? So now we get a new beta for the combined firm, right? Now if we get a new beta, we can calculate the new cost of equity, right? Using the CAPM model, right? And then this new after-tax cost of debt is given, right? So then combined with 2, we get new cost of capital. Again, weighted average cost of capital, right? Now this one will be here, right? The after-tax return on capital in the first year 1 to 5, right? The pre-tax margin increased to 4%, right? And also after year 5, beta drops to 1, right? We can calculate the cost of equity and cost of debt and cost of capital again. Everything else remains the same, except that the growth rate will be 10% in the first 5 years after Compact took over digital. Right? Now, the calculation here, then it will be very similar to the calculation here, right? I won't go into the detail because it's exactly the same thing, right? Just use the formula I used previously, right? Calculate the after-tax EBIT, net capex, changing working capital, that will be free cash flow, right? Then combined with the present value of the free cash flow in the first 5 years, with the discounted, with the present value of the terminal value, we get the firm value. Right? Now remember, this firm value is the firm value under the better managers of acquirers. Right? So this is how we do it. Right? Now let's go back to the slides so you can check on the slides calculation. Now, finally, we're gonna value the synergy, right? Now remember, what is the synergy? Synergy is 1 + 1 greater than 2, right? So then the other task here is to value compact, right? Now here, this one here lays out all the information you need to value compact, right? You can try yourself on the spreadsheet that I gave you, right? Exactly same calculation method, it's just numbers are different, right? Now, same thing, we can get a standalone value of compact, right? Now, finally, we can then calculate we can now value the synergy, right? We have the value of the digital under the optimal manager of compact. We also have the value of the compact and the status quo, status quo valuation. And the value of the combined firm will be 43, this number, right? So this will be the value of the combined firm. Right? Now, to value the synergy, we then need to make the following assumptions about the way in which the synergy would affect cash flow and the discounts of the combined firm, right? I mean, it must be improving the operating performance, right, as the synergy. So the combined firm will have some economies of scale, allowing the firm to increase the current after-tax operating margin slightly, right? The annual dollar savings will be approximately 100 million, and this will translate into a slightly higher pre-tax operating margin. Right? So now the current operating margin will be, right, this is EBIT compact plus the digital, right, divided by sales, divided by the total sales of these two companies. The operating margin now will be 9.11%. Right? Now we assume that there is a 100 cost savings here, right? Because we assume that the annual dollar saving will be 100, right? Therefore, the numerator here will increase by 100, right? And then the new operating margin will be 9.36%. So in that case, the combined firm will also have a slightly higher growth rate of 10.5% over the next 5 years, right? Because of this operating synergy, right? So this is, so now, because the debt ratio changes, right now we need to calculate the new beta again, right? So this is the calculation. We need to first calculate the unlevered beta for digital, the unlevered beta for compact, then we get unlevered beta for the combined firm, right? Now, then we need to get a new levered beta, right, under this new debt ratio, new debt to equity ratio, right? And then get a new cost of capital after the merger. Right? So this is synergy estimation. Now let's go back to the spreadsheet again. Now, if we need to calculate the beta of combined firm, right? So again, what do we do? We have the unlevered beta, but we have the digital's post-merger debt to equity ratio, compact's post-merger debt to equity ratio, right? Then this is the new beta, right? Now we need to get digital's unlevered beta first using the formula, right? So that's 1.25. That's the, so again, this is the optimally managed beta, right? First, you unlever it. And then we can also calculate the compact's unlevered beta, right? Here we assume that they share the same beta, right? Because here we already assume they are the same firm, right? We just need to, in addition, consider the synergy estimation on top of the optimal managed firm. Now we have two firms unlevered beta. Then we have the value of the digital optimally managed, right? The value of the compact. Then we calculate the weight of two companies, right? Now we can calculate unlevered beta, right? That's the weighted average of two companies unlevered beta, with the weight being the weight of the digital of the two firms, right? And then we can get a new levered beta, right, by applying this new cost of capital on the slide, right? Then we get new cost of equity, cost of debt is given, then we get new cost of capital. Right? This is how we get a new beta. So then everything else is already there, right? So the growth rate is updated to 10.5% thanks to the synergy, right? Pre-tax margin is also higher. Revenue grows at higher rates, right? Now the capex depreciation is the sum of the two, right? Everything else is similar, right? So the assumption is similar. Now again, use the calculation method I used before. We can calculate the value of the combined firm basically, right? Now this is the value of the firm already incorporates the synergy estimation, right? Now what is the present value of the synergy? We have the value of the compact, we have the value of the digital that will be optimally managed by the compact, right? The sum of the two will be this one, right? So then the difference will be the synergy, right? That's 2432.06, right? Remember, there's a difference between operating synergy and improvement because of the managerial talent, right? Remember when we talk about the optimally managed digital firm, we don't assume any capital structure change. We assume everything else is the same, except that the manager is able to impound a higher growth rate, right? So the synergy is now here, right? So then we can calculate we assume that it takes 3 years to realize the synergy. Then we can calculate the present value of the synergy. Okay, so now let's go back to the slides. So this is our estimation, right? So the value of the combined firm is this number. The value of synergy is this one. So suppose it takes 3 years to create a synergy, then we get this number, right? So this is our example. You can play around with the spreadsheet a little bit, right? Now, how accurate is this DCF model in practice, right? This paper by Kaplan and Rubeck, they conducted a study of 51 highly leveraged transactions between 1983 and 1998, right? And then they compared the market value with the discounted value using the cash flow forecast that is using the DCF model, and relative to the actual purchase price, right? And among the 51 transactions, 43 were management buyout and 8 were recaps, right? And then they found that the median estimates of DCF were within 10% of the market values of the transactions. So the DCF valuation performed at least as well, if not better than the comparable methods. Right, so when they added comparable data to a model, the explanatory power of the DCF estimates improved. Right, so this suggests that, so DCF model alone, it doesn't perform as well as the actual purchase price. But once we incorporate information from comparable methods, right, which we're going to talk about in a little bit. So if you incorporate these two methods together, DCF model improves. Right? For example, one way to incorporate comparable methods is that when you estimate a growth rate, right, you can pick a couple of industry peers, right? Let's say you have 10 industry peers. Their average growth rate is like 5%. Now, when you assume that in the future, your growth rate, you don't want to be too far away from your industry peers. Right? This is one way to incorporate the comparable methods, right? Because comparable methods basically means that your valuation somewhat depends on the valuation of your peers, right? Of the company that operate in the same industry as you do. Yeah? This is comparable methods. Okay. Now we talk about this relative valuation or comparable method here. So this relative valuation, so all we have been talking about is absolute valuation, right? How much cash flow is generated there. Based on the absolute cash flows generated, we calculate the value. But there's also an alternative way, which is called the relative valuation. That is also called the comparable company approach. Right? So this relative valuation is much more likely to reflect market perceptions and the moods than discounted cash flow valuation. Right? And this method could be an advantage when it's important that the price reflect the perception, as is the case. Right? So this is very useful in the IPO, essentially.
right? Because in IPO, it is very difficult to look at a cash flow, right? Because I mean, usually if you want to buy an IPO stock, if you want to bring a company to IPO, you cannot rely on the future of the cash flow estimates very uncertain, right? Because the company is already, it's still growing in the initial stage. That's why the estimates are very difficult. Therefore, you can rely on comparable companies, right? Companies that have the same businesses, a similar industry, to look for estimates of growth rate. So with relative valuation method, there will always be a significant proportion of companies that are undervalued, overvalued, right? For example, you can look at industry median, right? So any company that offers PE ratio that is higher than the industry median, it will be like overvalued. If it's lower, then it's undervalued, right? Basically, you use a set of company as the benchmark. That's the idea. Now, in general, this is the comparable company approach, right? You can calculate the multiple using this approach, right? The numerator is what you are paying for the asset. The denominator is what you are getting in return. And then you can calculate this multiple for every single company and then compare this multiple. So one of the examples of this multiple is PE ratio, right? This is one of the examples. For example, in the numerator, you can calculate the market value of the equity, right? And the price, right? Price is one type of what you are paying for the asset, right? And denominator is what you are getting in return, right? For example, cash flow to equity, earnings, right? So, and book value of equity, right, etc. This is a generic word. So price earnings ratio, it's one way to look at it, right? And there are many variants, right? So they are based on how the price earnings are defined, right? Price, it could be the current price. Price, it can also be the average price over the year. And EPS, it could be the EPS in the most recent financial year. It could also be the EPS in the trailing 12 months, right? Depending how you define the price and earnings, you can have different versions of the price earnings ratio. And so you can see price to earnings ratio by itself, it is a multiple. Okay? You can calculate this multiple for a number of different companies and then compare this multiple across these companies. Another example for this multiple is called enterprise value EBITDA multiple, right? Again, the idea is that in the numerator, you put in market value. In the denominator, you put in the earnings, right? Earnings, etc. Those kind of value that are coming from the balance sheet. So if you calculate this ratio, it will be obtained by netting cash out against that to arrive enterprise value. And then you divide it by earnings before interest, tax, and plus depreciation. Right? So that is the market value of equity plus market value of debt minus cash divided by earnings before interest, tax, and depreciation, right? This is how you do it. So comparable multiples, they're regularly, we call this one comparable multiple, right? Because you compare the multiple across the number of different companies. They are regularly used to value businesses, right? They are also a quick and easy method to come up with a value for a company. So, and like DCF method, they can be used to value both public and closely held businesses. Right? And there are basically 3 steps in using the comparable multiple analysis, right? First, you select the appropriate comparable company, then you select the correct multiple, right? For example, PE ratio. Finally, you apply it to the relevant earnings base. Right, so here is an example. The most commonly used is PE ratio, right? Now, if we multiply derived PE ratio by our target company EPS, we get estimated stock price, right? This is how we do. So for example, let us say that we have analyzed 10 comparable companies and found out that the average PE ratio is 17, right? Now, in our case, we can multiply this PE ratio by the target company's EPS, right? Now, then we can figure out whether the company is overvalued or not, right? In our case, if the EPS is $3, in our case, the stock price will be 41, right? Then this is the estimated stock price. We can use this one to see whether the company is actually overpriced or underpriced. Right? So if the multiples that are derived from analysis of the historical earnings, then they are trading multiple.
if they are derived based on future earnings, they are called forward multiple, right? So other multiple are like EBITDA multiple, right? So here EBITDA is used as a proxy for cash flows. Right? So the question here is, are the comparable companies from which we derive the multiple truly similar to the target P value, right? I mean, it could be they're very different in many aspects. Therefore, the P ratio you observe, they're not very comparable. Right? And also, are they more valuable or less valuable? Right? So in that case, the target's difficulty should be reflected not only in the lower earnings base, but also in lower comparable multiples, right? Which reflect lower earnings growth in the future. Right? So that is compared to the peer, compared to the industry peer, whether the target company has a higher or lower comparable multiple, right? I mean, actually in the findings, that's also a very common section that discusses the valuation multiple, right? Whether the valuation, how the valuation compares to the industry peers. And comparable multiples, they're forward-looking measures, right? For example, a buyer might pay 7 times EBITDA, right? Not for access to the past EBIT level, but for future cash flow, right? This is usually the case. And when the market establishes specific acquisition multiple for different company, right? So they will also do a transaction or acquisition multiple, which is, let's say this industry has 7 transactions before. Let's say, what is their premium? What is their multiple of these 7 transactions? Then this is used to serve as a benchmark to say whether the current deal, whether the price you pay for the current deal is overpriced or not, right? Or whether the company can generate future cash flow as those peers do. Right? So finding the multiples for companies is the first step, not the final step, right? And then the Delaware Cut believes that there must be a step, reliable basis for establishing this comparability across the company you find as the basis. Right? And if you have find out these outliers, right, you need to think about whether you want to drop it, right? Because if you find many outliers, which for example the P ratios are extremely high or extremely low, then you might think that they are not so representative of the industry average, right? So that's why in that case you might want to drop it. For P ratio, they are very often studied and measured, and we need to make sure that they apply to permanent income, like free cash flow in forever, right? And this is the income that excludes non-recurring one-time earnings. So in the context of P multiple, a trading multiple could be a recent stock price divided by earnings in the last full accounting period. Then a forward multiple can be a current stock price divided by forecasted earnings, right? There are many kind of versions of P ratio. And this final table shows the average P ratio by industry. Right? You can see in general, the financial services, they have a very high P ratio. Right? On the other hand, the transportation has a very low P ratio. Right? Okay, so this is pretty much this week.